class, we'll be talking about IAS 36, which talks about the impairment of assets. And before we start, we have objectives or goals that we want to achieve regarding this standard, because this standard is actually one of the most tested standards in the ACCA and even ICAN. So at the end of the lecture, you should be able to understand the purpose and scope of IAS 36. You should also be able to familiarize yourself with the key impairment terms. You should also be able to identify internal and external indicators of impairment, perform impairment tests on assets and cash generating units. You should also be able to recognize and reverse impairment losses when appropriate. Then you should also be able to account for and disclose impairment in the financial statement. So in order to ensure that this experience is actually a wonderful experience for you, to be an engaging class, to be an interactive session, to not just be one-sided, I talk alone, you would also need to talk, especially considering the fact that you are a chartered accountant from the ICAN perspective. So, Damilola, what do you understand by impairment? Like in your own word, what is your own basic understanding of impairment? Yes.
Okay. Impairment is basically, I would say.
Don't look at the screen.
Okay, I just have an idea. It's to ensure that the amount is more than the recoverable value of an tangible asset. Okay. Or maybe intangible as well.
Okay. That's a bilantial. Oh, welcome, Mr. Yusuf. You're actually on time. Not actually gone far. So far, what I've actually talked about is just the objective of the class, what we tend to achieve, which I'm currently projecting. Can you see my screen?
Yes, I can.
Okay. So before you joined, Dami actually said, gave a perspective on what impairment actually means. And I would also want you to bring in your own perspective, because to be honest, I want this to be an interactive class so that we all understand and achieve our objective of it. So, Mr. Yusuf, the floor is yours. So just tell me what do you understand by impairment? If you are talking, you're on mute too.
It's just and to simplify it, it's just a reduction in the value of an asset, PP, due to wear and tear.
Okay.
Or probably reduction due to reduction in the economic value of that asset.
Okay. Fair enough.
As a result of maybe internal and external factors.
All right, Mr. Yusuf, are you done?
Yes.
Okay. Thank you for that brilliant explanation. So before I talk about IS, before I talk about impairment, it's important for you to understand one of the fundamental characteristics of financial information. Mr. Yusuf, do you have ICAN too?
Yes, I do.
Oh, okay. So that means it makes my perspective make sense. Okay, that's fine. Because Dami also has ICAN. That's fine. So one of the fundamental characteristics of financial information is faithful representation. So what faithful representation simply means is that the financial statement should actually be true, should be complete, it should be neutral, and should be free from error. What is in the financial statement should actually be should actually be the true picture of the company's finances. It should not be full of errors. So one thing about faithful representation is that if a company says the assets in my books is 20 million. That 20 million should actually be the actual value that the company's asset worth. Now, in relation to impairment of assets, what this impairment of assets is just trying to talk about, IAS 36, is saying that assets should not be carried more than its recoverable amount. That is, the amount at which you are recognizing it in your financial statement should not be more than the amount at which you can get it in the market, that if you decide to sell it, or the amount at which you will get when you based on the cash flow of the company. That's number one. It also ensures that the company's assets, if the company's asset is more than its recoverable amount, it means that the asset is impaired. Then, one of the objectives of IAS 36 is that it also tells us how to assess for impairment, how we measure for the impairment loss, and if there is a reversal. Now, it is important to understand that there is a scope for this IAS 36. That is, what are the assets that IAS 36 applies to? Number one asset that it applies to is IAS 16, which is property, plant, and equipment. It's also applicable to intangible assets. It's also applicable to goodwill. That is, when you acquire a business, the inherent benefit from acquiring that business is your goodwill. So IAS 36 is applicable to goodwill. Then investment property. Investment property there's a separate standard that covers it, which is IAS 40. So, but what that standard says is that an investment property can be measured at both cost model and fair value model. But for the cost model perspective of investment property, IAS 36 is applicable to it. Then when it comes to investment in subsidiaries, associates, JVs, IAS 36 is also applicable to it. So once you understand the scope of the asset that IAS 36 is applicable to, then when exam comes, you'll be able to understand what and what you are not supposed to apply impairment of asset rules to. Now, it is not all the assets that a company owns or a company controls that is covered by IAS 36. For instance, inventories, deferred tax assets, financial assets, assets arising from employee benefits, contract assets, non-current asset held for sale. These assets are not covered by IAS 36. And the major reason why they are not covered by IAS 36 is because they have a separate, their standard already addresses how these assets will be valued. So in order to avoid duplication, IAS 36 does not even talk about anything that has to do with inventory, deferred tax asset, financial asset, contract asset, biological asset. So IAS 36 does not talk about it. When you see like trade receivables in exam, it's expected that you should ignore when you're calculating your impairment, except if the examiner states otherwise. The reason being that trade receivable is a financial asset, and there's already a separate asset standard that actually addresses it, which is IAS 39. So it is important for you to just understand what assets are applicable under IAS 36, what assets are not applicable under IAS 36. Then before I go forward, do you get the perspective I'm coming from before I move forward? Dami and Yusuf.
Yes, sir.
Okay. Thank you.
Sir, could you please explain that last part? I think you mentioned something around trade receivables.
Okay. So like I said, the way IAS 36 works, IAS 36 is impairment of assets. It means that the assets that IAS 36 is talking about is not all assets. Because we have different examples of assets. We have property, plant, and equipment. We have furniture and fittings. We have inventory. We have motor vehicle. We have trade receivables. We have cash equivalent, cash at bank, biological assets, etc. But it is not all these assets that are applicable under impairment of assets. Assets like trade receivables, like I mentioned earlier, they are not to be treated under IAS 36. And the reason why they are not to be treated under IAS 36 is because there is already a separate standard that addresses how trade receivables will be valued before you recognize it in the company's financial statement. So because of that reason, IAS 36 does not address valuation of trade receivables. And aside from trade receivables, the other ones are listed on the screen, the inventory, tax assets. So the major reasons why it is not covered is because their respective standard addresses it. That is it. I hope I've been able to answer your question.
Yes, sir. Thank you.
Okay. So for us to have a good understanding of what this standard is talking about, we need to familiarize ourselves with the terms. So the first one is the carrying amount. What does carrying amount mean? Prior to the introduction of IFRS, carrying amount is net book value. That is that's the layman understanding of carrying amount. And it simply means the cost you acquired an asset less accumulated depreciation. If it is an intangible asset, less amortization and any impairment loss. That is what carrying amount means. It means the cost less depreciation, less impairment loss, any. That is what carrying amount is. Another name for carrying amount is your net.
So carry amount is cost less what?
Net book value. Net
book
value.
Yeah,
NBV.
okay. NBV, yes, sir. All right.
So,
sir.
Mr. Isu, do you have any question? Or am I too fast? Or I'm not too fast.
No, at all. I'm with you, sir. Please go ahead.
Okay, thank you. So, yeah, that's what carrying amount is. When you look at, for example, now if you have, you guys are accountants, you have seen a company's financial statement. When you go to their balance sheet, which we also call statement of financial position, you will see the amount they put their assets and their liabilities. Those amounts you are seeing there is what we call carrying amount. Those amounts, I want to believe that you guys have seen a financial statement before. I don't need to project any financial statement, or do I need to?
No, sir. We have.
Okay. So when you see a statement, when you open the financial statement of the company, when you go to the balance sheet or the statement of financial position, it is the amount of the assets, the individual assets you are seeing, and the amount of the individual liability, what we call carrying amount. Now, we move over to recoverable amount. Before I explain recoverable amount, I will need to talk about fair value less cost to sell and value. Now, what does fair value mean? Fair value is, or what is here, fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement. So this definition is the definition according to IFRS 13. That's where this definition is. Now, the thing about this, you don't need to cram it. That's why I'm here. I'm here to explain it for you in the best possible way for you to understand. Now, what this fair value means is that, let's use a building. You have an office building now. The office building, in your books, in your financial statement, you're seeing that the office building is 30 million naira. That is the value of your building after lessing depreciation. However, if you decide to sell that office building, that office building 40 million naira. That 40 million naira is what we call your market value, also known as your fair value. Are we on the same page? Means that fair value is your market price or your market value assets. That's what fair value means. So if I decide to sell, or if I have a motor vehicle, that my motor vehicle in the market, people are willing to buy that motor vehicle for 5 million naira. That 5 million naira is for fair value. Fair value and market value. Although there's a school of thought that says that, well, the best way to understand fair value is to come from the perspective that when there's an active market for an asset, how much will this asset, how much will it worth? That is what fair value means. So for cost of disposal is saying that, okay, if I sell that asset today for still using the motor vehicle example, if I sell the asset today for 4 million naira, that motor vehicle, okay, the market will price. How much will it cost me to dispose it? For example, now to dispose an asset, one example is you will need to advertise. That's cost of disposal. You will need to pay maybe a commission. It might be a sales. You might not have time to dispose that motor vehicle. So you need like a salesman. The commission you pay that salesman can form part of your cost of disposal. So that's the meaning of this cost of disposal. Then I said I'll come back to the recoverable amount because I need to explain the components of recoverable amount before you understand what recoverable amount means. Then value in use. If I go to value in use, do you get what fair value less cost of disposal, what it entails?
Yes, sir.
Okay, Mr. Yusuf and Mr. Bayo that just joined. You also understand what I just explained, or I was too fast?
Definitely. Okay. Well understood.
Okay, thank you very much. So value in use, on what is here is value in use is the present value of the future cash flow expected to be derived from an asset or cash generating unit through its continued use and eventual disposal. What value in use means is that this asset we are using now for the business, how much can we make from that asset in future? That's number one. How much can we make from that asset in future? How much can we make from using that asset in future? Number two, how much would it cost us in using that asset? Then number three, if we eventually dispose that asset, because one thing about assets is that they usually have this useful life, estimated useful life. Every asset you acquire in a business would have estimated useful life, except from specific asset like intangible assets. But for the purpose of this discourse, every asset usually have estimated useful life. It's just that when you go to companies, everybody have their own different estimated useful life. For example, now two companies can go and buy a motor vehicle from the same vendor, but when they now go back to their office, that motor vehicle that company bought, he can say that the estimated useful life is 5 years. Company B can say that it's 7 years. The reason why it is different is because they both have their own accounting policy. But the most important thing to understand is that in order for you to understand this value in use, you are trying to say that, these assets that our company has acquired or our company wants to use, how much are we going to generate from it in future? Because when a company acquires an asset, the expectation is that the company would, in one way or the other, benefit from that asset. Because once there is no benefit from a particular item, that item ceases to be an asset. It cannot even be called an asset. So a company acquires a motor vehicle, a company acquires a plant and machinery. The reason why they are acquiring this is because they want to get future economic benefits from it. The economic benefits is, in a layman, most times is usually cash inflows, or it will reduce their cost, basically. So, from the perspective of this value in use, what it just basically means is that any cash the company will expect to get in future from using that asset, number one, the inflow. How much will it cost them to use that asset in future? Then three, if they eventually dispose it too. So that's what value you use it. And the thing is, if, for example, I buy a motor vehicle and I say that, this motor vehicle, in year one, the company estimate that this motor vehicle will make 50,000 in year one. In year two, it will make $30,000. That estimation is what we call cash inflow. Then the outflow, you might be wondering, why is Tunde saying outflow? Because of course, because it's an asset, there will still be regular maintenance. They will do regular repairs and maintenance. Because at some point in time, the asset might have one or two issues. So they will need to want to service the asset. That's why we have to have outflow. So the same way the company is looking at the inflow, the company also look at, how much will it cost us to maybe repair it, or labor costs, people that would work on the machinery, how much. So those are like the outflows. Then the eventual disposal means that at the end of the useful life, how much would you spend? And how much would you realize when you sell it? That is what it means. That is value in use. When we'll do examples to further clarify what value is. Now, going back to this recoverable amount is just saying that it is the higher of fair value less cost to sell and value in use. Meaning, if your fair value less cost to sell is 50,000, your value in use is 30,000, your recoverable amount is 50,000. That is what. This is to simplify it for you. There's book will tell you either sales or compensation. But never mind about that. The basic concept is that it is the higher of fair value less cost to sell and value in use. Higher of it. If your fair value less cost to sell is 50,000, your value in use is 40,000. Your recoverable amount will therefore be 50,000. That's it. Then now, the cash generating unit. I would explain this in subsequent subheading because it is a separate subtopic. But what does corporate assets mean? Corporate assets are assets excluding goodwill that contribute to the future cash flow of more than one CGU. They support multiple units and cannot be attributed to cash generating. Now, in some entities, they usually share assets. There are some assets that they are not a standalone. That is, if in a group we have company A and company B, they are sister companies. If they are using the same IT infrastructure or they are occupying the same building, that IT infrastructure that they are using, given that it is shared, that is what corporate assets mean. It's not a standalone. It is usually supported. It supports multiple units because without the IT infrastructure, company A or company B would not function effectively. So IT infrastructure, building shared by company. In some other cases too, research and development facilities. Those are corporate assets. Then what is depreciable amount? Depreciable amount is your cost less residual value. That's what we call depreciable amount. That is, if you have a vendor that you bought an asset for $50 million. You then estimated that, that asset at the end of the useful life, you'll be able to get the scrap value of that asset will be 40 or it will be $10 million. Now, the difference between the $50 million, that is the amount you used to acquire that asset from the vendor, and the $10 million you estimated that you get from that asset, which is the scrap value, it is your depreciable amount. The cost minus scrap value is depreciable amount. Now, to the main topic, impairment loss. What is impairment loss? Impairment loss is when you're carrying amount, when the carrying amount of an asset exceeds the recoverable amount of that same asset. Impairment loss, let me come again, is when the carrying amount of an asset exceeds the recoverable amount of that same asset. Don't forget, I said carrying amount is what? The amount that was recognized in your financial statement. That is when you look at your financial statement now. Those values, when you look at the statement of financial position, those values that you put in your statement of financial position, Those are the carrying amount. Then your recoverable amount, I said, is the higher of fair value less cost to sell and value in use. The higher of them. So if your cost, your carrying amount rather, is more than your recoverable amount, means that that asset has been paid. Because let's look at it realistically. You are saying that in your own book, in your account, book of accounts, your asset is 50 million. However, if you decide to sell that asset today in the market, you will not see more than 40 million naira or $40 million from that asset. What does it mean? It means that you have overstated the value of that asset. And your financial statement or your financial information must be faithfully represented. So in order for you to do that, you need to adjust it to reflect the current economic reality of that asset. That is the whole purpose of impairment. Because why would you be carrying an asset more than the market value or more than the amount you are expected to realize from that asset? Makes no sense. So because of that, you need to ensure that what is reflecting in your financial statement must show the true economic reality of that asset. Then what is useful life? You already know what useful life means. It means the period of time that asset will use. It means the period of time for some other assets, it can be unit of production that you are expected to derive from that asset. So before I move to how to identify an impaired asset, I don't know whether there's any question or maybe there's something I need to clarify before I want us to be able to understand. Because this standard is one of the most important standards in SBR. Yes, Yusuf and Dami, I'm reading the invite to you.
I think I'm fine from my own end.
Okay.
I'm with you, so I don't have any question to ask for now.
Okay, thank you. And Madam Dami.
I'm fine as well.
Okay, please let me know if I'm too fast, because sometimes I know I might be talking too fast. But please let me know. You can always draw me back, or you can use the raise your hand symbol on Teams. Thank you. So, how to identify an impaired asset? For you to identify an impaired asset, in every circumstance, what you usually look out for indicators of impairment. That is, at the end of their year end, to assess whether their assets, there are indicators that their assets have impaired or not. At the end, so if your year end is 31st of December, so during that period, you would have to look at, this asset that I'm recognizing my books, has it impaired? Look at the external factors and internal factors, or external indicators or internal indicators. Now, to start with, what are external factors? External factors or external indicators are what is beyond the control of the organization. The organization cannot control it. What is beyond them? For example, a significant decrease in the market value of the asset, or a significant drop in the market value of the asset. So, you are saying in your books have a property, plant, and equipment of $75 million. However, you come across news that value of assets have reduced significantly due to one or two policies introduced by the government. What does this tell you? It means that this is an indication that what you are recognizing in your book, there's a risk that you are overstating the value of that PPE. That is an external indicator. Let me come again. What significant drop in market value of assets means is that, you have a PPE of $75 million in your books. That PPE of $75 million is what you are recognizing in your financial statement. You now come across news that due to introduction of government policies, the value of property has reduced significantly. What that means, that news, that impact of that news is that what you are carrying as a year ago, you are overstating it. You are not telling the users, no, they are users. They have the internal users. So you're not telling those users that you're not telling them the truth. It's like you are lying. I said that should be 30. You are telling the user that it's 50. So what does it mean? It means that that asset that asset has been overstated. That's what. The second one is advanced changes in technology, legal, market, or economic conditions. Now, what this means is when there's change in technology, it can affect the value of assets. Let's use a very good example. Before then in Nigeria, there was a time that DVD was reigning. People would just be using DVD in their house just to go to all these video club, rent CD or rent cassette, and once you just go to your house and put it in. But when Netflix came, change in technology. What does it do? Netflix actually sent the DVD people out of the market. Or maybe there are even some people that still use it before. A significant number of people now in Nigeria or across the whole world itself, they don't use DVD like before. Because of change in technology, it has phased out the era of DVD. For legal too, government can introduce a regulation banning the product. And once government bans your products, it means that whatever you are recognizing, maybe the assets you are using to make that product, there's a tendency that you are overstating that asset. That's an indicator that, you need to assess for repayment. Yes. Then economic conditions. Look at now in Nigeria. There was when President Tinubu, when he got in, he made significant announcements. Like number one, he removed fuel subsidy, and he also devalued Nigeria. Those two policies or those two announcements actually had significant impact on businesses. He also made things to be so much expensive. He also affected the purchasing power of buyers. So because of the purchasing power of buyers, it might also be important for companies to actually evaluate. Also be important for companies to actually evaluate the value of the assets. This asset I'm recognizing. Can buyers, even if I decide to sell it today, can people be able to afford it? It's also like an indication that companies should actually assess for the payment. That's it. Then the other point is increase in market interest rate that reduces recoverable amount. What this basically means is that market interest rate is just the borrowing rate. How much is the CBN rate now? Is it 25%? The higher your CBN rate or your borrowing rate, it effectively affects your recoverable amount. It means that recoverable amount, specifically as your value use, it means it is going to be reducing. What do I mean by that? Value use, like I mentioned, is that there are three components of value use: future cash inflow, future cash outflow, and disposal value. Normally, when you come across value use in the exam, the examiner will expect he will give you sometimes they will give you the amount you will make on that asset in future. The inflow, they will give you outflow, then they will give you most questions is outflow and inflow. So because outflow and inflow are different, it's expected for you to just find the difference. If your outflow is 50, your inflow is 80. 80 minus 50, 30. But don't forget, you are calculating future. So it means that you need to determine the present value. Because the $80,000 in future is not the same $80,000 now. You will agree with me. $80,000 now is not the same thing. What so it's important for you to now use what we call a discount rate. So discount rate will now show what will be. Oh, you are saying that you will make 100 million in the future. Okay, what's that the value of that 100 million now? That's the meaning of present value of future cash. So, and in doing that, you use interest rate. So the higher the interest rate, the lesser value. So once that happens, it's also important for companies to assess whether payment has. Then another external factor is market capitalization is less than the carrying amount of net assets, specifically for entities. Okay, you don't need to think too much of this. What this one means is that the carrying amount of your net asset, what is net asset? Total asset minus total liabilities. So your total asset is, an hypothetical scenario, is $70 million. Your total liability is $40 million. What does it mean? You know, you cannot have asset and liability, but they are different. They have different meaning. So 70 minus 40 is 30. That's 30 million. So that 30 million is the net asset. Now, what market capitalization is saying is that in the companies that are listed, they usually, when you say company is listed, it means that they have shares that the general public will buy. So they are always valued in the stock market. What is the company's value in the stock market? If the company value in the stock market is, let's say, 40, and your net asset is, let's say 50, what it means is that it's also an indication that the company needs to assess whether, have their assets actually impaired or not. That is a very good scenario. So if the market, because you might ask that, why are they looking at that? Because it means that it is the way the general public is perceiving the company. The way they are perceiving the company. If the value of the company is low, why is the company now in their books overstating their value? That is what this means. Then, in the internal indicators, like I mentioned, external indicators are things that are outside the control of the business. But internal indicators are what is within the organization, what they can control. Examples are physical damage or obsolescence. So when an asset is old, it's important for the company to actually check whether, the value of this asset, hope it has not impaired or not, when an asset is old. Then number two is, if the company is having consistent losses or their sales is reducing, they also need to check whether their asset has not impaired or not. That is what this means. If they are having consistent loss, you need to check whether, this asset, is it producing low quality products for us? Let's assess it. Then number three, if they want to discontinue their business units. So usually in practice, companies come together, merger and acquisition. So when there are plans for companies merging, that is company and company coming together to form company AB, it could also be an indicator that they need to assess whether their assets have impaired or not. Then another one is evidence from internal reports indicating the asset is underperforming. So in companies, they usually finance units, internal audit units. So if all these units now, there are reports from them that they are not actually producing as much as they can. For example, now an asset that when they purchase it, it is producing at least in a day 50,000 units of goods. But later on, they realize that the asset is now producing. There is a report, internal report, that the asset is now producing 20,000 units. That can be an indication for the company to actually assess whether the payment has actually occurred or not. So this indicator applies to all assets. However, if there is if no indicator exists, then no further action is required. Means that the value of your assets, the value you stated in your book is fine. What you have stated, if you said your property, plant and equipment is 50 million, $1 million. Actually, 50 million. It's fine. No issues. However, goodwill and intangible assets with indefinite useful life must always be tested annually, regardless of any of these factors. The company must always test for goodwill and intangible assets with indefinite useful life. Please take notes. Aside from any other assets, goodwill and intangible assets with indefinite useful life. When I say indefinite useful life, it does not have a defined useful life. So goodwill and intangible assets with indefinite useful life the company must always test for it on an annual basis. They don't need to wait for any indicator. They don't need to wait for drop in market value. They don't need to wait for advanced change. No, they must always test for impairment when there is goodwill and intangible assets. So number one step, in order for you to identify an impaired asset, look for the indicator. The indicators are external indicators and internal indicators. If there are no indicators, if these indicators they do not exist for this asset, there is no further action required. It means that whatever value you have stated in your books is correct. However, goodwill and intangible assets, definitely, like, you must always test it annually. Always test it. Then step 2 is measure the recoverable amount. And how do you measure the recoverable amount? Don't forget, recoverable amount is higher of fair value less cost of disposal or value use, higher of them. Then, after you've done that, you compare it with your carrying amount. So when you compare, if your carrying amount is more than your recoverable amount, it means your asset has impaired. What it means is that your asset value is overstated. Then you recognize your impairment loss. Before I move further, do you have any questions? Hello, Madam David. Do you have any questions?
I think I do.
Oh, okay. I don't want to go too far before
So when we started, you mentioned something around that not all assets are to be not all assets are to be treated. I mean, that requires impairment.
Yes.
Not all, you make an example regarding trade receivables, inventories, and those assets that.
Yes.
Or I was thinking goodwill too should be among the assets that doesn't need to be treated as an impairable asset.
So goodwill is not part of it. The standard is not.
Yes.
In fact, like I just mentioned earlier, you must always test goodwill every year. You don't even need to wait for indicators. You don't need to wait for an external indicator or internal. A company is required to always test for impairment of goodwill. They must always test for impairment for goodwill. It is very important. In fact, for this level, they might want to ask questions on that, around that goodwill, impairment of goodwill. But bear in mind that a company is expected to always test for impairment of goodwill annually. Not just goodwill, goodwill from business combination and intangible assets with indefinite useful life. Those are the two. Any other class of assets, like PPE, motor vehicle, those ones you have to wait for indicator. Oh, at the value of this asset, as if, oh, okay, then means we have overstated. All those classes of assets, those ones you're waiting for. For goodwill and intangible assets with indefinite useful life, you don't have to wait for
indicators. Okay.
So what this means is that impairment test is just carried out. Basically, impairment test is carried out by comparing your carrying amount of an asset with the recoverable amount. Impairment test is carried out by comparing the carried amount and the recoverable amount. Once the carried amount is more than the recoverable amount, impairment loss has occurred. Once the carried amount is more than the recoverable amount, impairment loss has occurred. However, once the carried amount is less than the recoverable amount, there's nothing like impairment gain. There's nothing like that. There's nothing like that. It means that what you have recognized in your book is fine. No further action is required. Let me come again. If your carrying amount is more than your recoverable amount, there is impairment. That's the way you test for impairment. You are comparing carrying amount and recoverable amount. However, if your carrying amount is less than your recoverable amount, no further action is required. It means that what you have stated in your book is fine. Don't forget, in accounting, there's what we call the prudency concept. I don't know if you're familiar with it. Prudency concept. Prudency concept is saying that don't always anticipate for profits. Always make provision for losses. Because if you're anticipating for profit, there's always a risk that you would always do magu. Let me use, for lack of better word, you always do magu. That is, your magu would tend to mislead the users of financial statements. And you're not supposed to mislead the financial statements. Because one of the essence of preparing and auditing a financial statement is that it has to show a true and fair view of the transaction of the business. So it is important that if your carrying amount is less than your recoverable amount, just move on. It means that there's no impairment. No impairment loss. Please, there's nothing like impairment gain. Take notes. So impairment loss is just when your carrying amount is more than your recoverable. That's it. So recognition of impairment. Now, how do you recognize impairment? Recognize for impairment. Recognize impairment in the statement of profit or loss, also known as your income statement, and recognize it in our balance sheet, also known as your statement of financial position. Now, you might be wondering, how do you recognize it as statement of profit or loss? We take it into as other expenses, or we call it out as impairment loss. So the companies usually recognize impairment loss as an expense in their financial statement. That's what they recognize it. So when I say as an expense, it means that it can either be cost of sales or administrative expense. That's what I mean. It's an expense. It's bear in mind. It's not an income. It's an expense. In the statement of financial position, carrying amount. What the impairment loss will do is to reduce your carrying amount. That is what it does. To reduce it. So the same way, you know how depreciation works. The same way you say, oh, the cost of motor vehicle is $50 million. Depreciation is 10 million. You know that once you have cost 50 million, depreciation 10 million, means that the carrying amount of your assets is what? 40 million. Now, the same work that depreciation has done to the cost of that asset is the same work that impairment loss will also do. The same way you are reducing the cost of that asset by the depreciation value, that is the same way you would reduce the cost of that asset by the impairment loss value. So if your cost is 50 million, your depreciation is 30 million, your impairment loss is 10. What it means is that the carrying amount of that asset will be 50 minus 30, which is the depreciation amount, minus 10, which is the impairment loss amount. The carrying amount will then be 10. 50 minus 30 minus 10 plus 10. So that carrying amount, it will be reflected in such a way that it is the same thing with your recoverable amount. Because the whole point of impairment loss is that you are benchmarking it with your recoverable amount. That's the whole point of impairment. You are benchmarking it. If it is more than your recoverable amount, you take it to, you reduce it. You reduce the value of your asset to reflect recoverable amount. But if it is less than your recoverable amount, it means that it's fine. Then, what is the accounting entry? The accounting entry means just how are you going to post it to your books? You debit P&L, which is your cost of sales or administrative expenses. Then you credit asset account. So let me try and this scenario, let me explain it with an example. A company has a carrying amount of 10 million, recoverable amount of 7 million, impairment loss of 3 million. So let's try and do the accounting entry. Sorry, let me share zero of please let me know whether you can see my screen.
Yes, sir, I can see your screen.
Okay. So based on that question, that scenario, the scenario is carrying amount is 10 million. 10 million naira. The recoverable amount is 7 million. Recoverable amount is 7 million. Impairment loss is 3 million. So this is impairment loss. Now, what is the accounting entry? The accounting entry means that where are you going to take it to your books? So it is company will debit expense account. And you know that expense is always in your P&L. In P&L. So the expense can either be cost of sales or administrative expenses. Now the question you might ask is that so how do we now know whether it's cost of sales or administrative? It will be cost of sales if the assets that has impaired relates to your production. It will be admin expense if it does not relate to your production. That is, if it's a direct, if it's an asset that is directly attributable to your production, the impairment of that asset will go to cost of sales. But if it is an asset that is not direct to your production, to go to the impairment of that asset will go to administrative expenses. For example, let me use a company has a manufacturing outfit or a manufacturing company. That manufacturing company, the plant and machinery they use for production, if it impairs, the impairment loss will go to their cost of sales. However, if that manufacturing company they have a laptop that the finance unit usually use, that laptop impairs, will not go to cost of sales. Why? Because it's not related to production. It will go to administrative expense. That's what I'm trying to do. So you are going to debit expense in P&L, cost of sales, administrative expense, and credit asset account. So you're debiting this guy and you're crediting this guy. Yeah, so this is how it will be posted. So assets is usually a debit account. But once you credit an asset, it means that you are reducing the value of that asset. So that's why you are crediting assets, you are debiting your POL. Okay, let's go back to the scene. Okay. So accounting entry, if impairment is under evaluation model. So if the impairment is under evaluation model, what the standard says is that you should take debit other comprehensive income, credit asset account. That's what the standard says. Then still using the land is valued. Okay? So so before as I'm sharing my screen, let me just spending that time and share. Can you like explain what your own word? What does evaluation surplus mean? Hello, Madam Dami. Can you hear me?
I'm with you, sir.
Yes. So okay. Before I go to my question, let me try and paint a perspective. So what I'm trying to explain here is that accounting entry, because for SBR strategic business, but you also need to understand how it is being posted in the books of accounts. So there are two perspectives on how you post it. If it is under the cost model, it is this one the earlier explanation I gave. You debit POL, which is either cost of sales or admin expense, and you credit asset account. Then the second perspective is if it's under evaluation model.
Okay.
Then I now ask that, what is evaluation? Or what is evaluation? And what is evaluation surplus?
Revaluation surplus is when there is an increase in the value of an asset.
Yeah, you got it. That's brilliant. Thank you. So evaluation first. Let me explain what evaluation. Evaluation is when a company is adjusting the value of their assets to reflect economic realities of that asset, or to reflect the market value of that asset. That's what they call evaluation. Then evaluation surplus. We can either have evaluation surplus or we can have evaluation deficit. For the purpose of this class, because if I'm the one that will take IAS 16, but this evaluation basically specifically broad under IAS 16. But for this class, I will just focus on only evaluation surplus. So evaluation surplus is when the value of the assets in the market is more than the amount the company is carrying it in its books. If the value of the assets in the market is more than the value of what the company is carrying, it's what we call evaluation surplus. That's evaluation surplus. But if the amount at which the company is carrying it in the book is more than the amount in the market, what we call evaluation deficit. But for the purpose of this class, evaluation surplus is what we want to explain. Now, what typically the way evaluation surplus work is that in this question, they gave us that said land is revalued under IAS 16. It has a evaluation surplus of 2 million and an impairment loss of 2.5 million arises. So in this case now, the scenario 2 is saying that there is an impairment loss of 2.5 million. There's an impairment loss of 2.5 million, and there is a evaluation surplus of 2 million. Now, this is what the scenario 2 is talking about. Now, before I further explain this scenario 2, do you clearly understand how this scenario 1 works? Madam Dami, you clearly understand how this scenario one?
The scenario one, yeah, the carry amount is more than the recoverable value. That's why we have the impairment loss, and the entries is for us to
Yes.
debit the expenses and credit the assets account.
Yes.
Yeah, but I'm trying to understand the evaluation
Okay.
model. The end,
Okay,
yeah,
okay,
where you have
okay,
the impairment
okay.
loss and the recoverable amount.
Yes, that's
Yeah, evaluation. Yeah.
so. Thank you. So, in the absence of evaluation surplus, which is this scenario one, we understand that you are going to debit POL and your credit your asset account. But where there is a revaluation surplus, what the standard says is that what you should do is, in fact, for you to even clearly understand it, what is the accounting entry of evaluation surplus? Okay, let's start with that. What's the accounting entry of evaluation surplus? Madam Dami, what's the accounting entry of evaluation surplus?
We debit the asset account.
Okay, you're not teaching me now. Asset debit, then
I think we'll credit other income.
comprehensive income.
Yeah.
Okay. Yes. Other comprehensive income, and other we will call it valuation surplus. Okay. OCI. Credit valuation surplus through OCI. Yes. You are correct. Perfect. So in this scenario now, when the company had this valuation surplus, this is what they would have done. Do you agree with me?
Okay.
Now, what the standard is now saying is that if you now find out later on that the asset has already impaired, you now have an impairment loss of 2.5. Your accounting entry will not be debit POL first. No. What you first do is you need to debit your revaluation surplus account to the extent of the value that is in that account. Let me come again. The standard is saying that, yes, typically, when there is impairment loss, debit POL, credit asset account. However, when there is evaluation surplus, what you should do is that impairment loss that you've now had, you must go and take it to evaluation surplus account to the extent of the amount that is there. That is, what I mean is, if in this scenario, evaluation surplus now account has 2 million, evaluation surplus has 2 million, but impairment loss has 2.5. What the standard is saying is that take this 2.5 million, take 2 million out of it, debit evaluation surplus. That is, you come here, debit valuation surplus account with 2 million. Then go to assets, 2 million first. That's what this means. Then there's a balance of 500,000. That 500,000, you now do debit POL. Profit or loss, which is the expense. Profit or loss, 500,000. 500. Then credit asset with 500. This is how you are supposed to do it. So what does this mean? This effectively means that when you check the company's books, the company does not have evaluation surplus again. Effectively does not have evaluation surplus. It means in their books, your evaluation surplus will be 0. However, they will have impairment loss in their POL of 500. Assets will be impaired by 2.5. That is what this means. Let me come again. When there's when an asset has the valuation surplus in year one, what you have done is that you have debited your asset account, have credited your other comprehensive income. Now, as you have credited your other comprehensive income, it effectively means that you have an account that the valuation surplus is sitting on, which is the valuation surplus account. Now, in year two, there was now impairment loss of 2.5 million. Now, in doing that 2.5 million, it will be wrong for you to now say debit 2 million, 2.5 million rather, debit 2.5 million to POL as expense, credit asset account 2.5 million. No. The standard says that if that asset that has impaired now has enjoyed evaluation surplus in the past, in posting the accounting entry, take the value of impairment loss to the extent of that evaluation surplus to evaluation surplus account first. That's what IAS 36 says. Then the balance you have left, take it to POL. So it means that when you have evaluation surplus, the credit side will still be the same.
Okay.
To still be the same as if you do not have it. But the debit side is what will change. Meaning you will debit two accounts when you have evaluation surplus. Debit evaluation surplus account and debit POL. If I change this amount, maybe let's say you can change the amount, make it, let's change it to 2 million. Let's make it 2 million. If it is 2 million, this will change. We will debit valuation with 2 million, credit asset with also 2 million.
2
But they will
million.
not, you're not taking anything to POL. You understand?
Yes. So when there is an excess in
Yes.
the value of the
Yes.
impairment, that's when we
Yes.
take it to POL.
Yes. Yes. So if the impairment loss is, let's say it's even 1.5 million. So what we'll do is we'll debit evaluation surplus with 1.5 and we'll credit asset 1.5. That's what we're going to.
Okay. So what will happen to the 500 balance from the revaluation surplus? Okay, it has reduced. It has been impaired already.
Yes. So what it means is that evaluation surplus you have in year one, that is 2 million. It has now reduced in year two to 500,000. It has reduced by 1.5 to 500,000. Do you get?
Yes.
Yeah. So let me go back to what document. Okay. So disclosure requirements. So disclosure requirements are the things that these are just a few. They are not limited to this. They are the things that companies are expected to actually disclose in their financial statement. Because as users of financial statement need to understand, oh, how this way impairment loss, how did you even get it? Or where did you recognize it? So that's what this disclosure requirement is all about. So what disclosure requirement entails, they're just telling the user of financial statement that this impairment loss, this is where I took it to the POL. This impairment loss, this is where I reverse it. This impairment loss, it is on revalued assets. This impairment loss is from cash generating unit. So that's what this disclosure requirement is all about. Yeah. So now let's do practical questions so that you'll be able to grasp all what I've actually said. Sorry, I'm coming. Just give me 1 minute. Okay. Can you confirm you can see my screen?
Yes, I can see your screen, sir.
Okay. Okay, yeah. The first practice question. Question 1. Funsure Limited holds non-current assets with a carrying amount of $345 million as at 31 March 2020. The asset had an estimated recoverable value of 382 million as at 31 March 2025. Required, calculate impairment, if any. Show how non-current assets will be recognized in the financial statement of Funsure Limited as at 31 March 2025. Okay. Yes. Illustration 1. Funsure Limited. They said calculate impairment loss, if any. So, in calculating our impairment, as I earlier said, carrying amount of non-current assets it will be 345 million. Then recoverable amount. $382. Now that we have the two elements in determining our impairment, do you think there is impairment?
Yeah, impairment. Impairment of 37 million.
Okay, are you sure?
So the carrying amount, no, there's no impairment. There's no, like, the carrying amount is less than the recoverable amount, so there is no impairment.
Exactly. So because the carrying amount is less than the recoverable amount, is no impairment. Yes, you are absolutely right. Because as I earlier mentioned, the rule of IAS 36 is that impairment will occur where the carrying amount of an asset is higher than the recoverable amount.
Yes.
So no impairment. So no impairment given that carrying amount
It's less than recoverable amount.
So now, what do you think? They say show how the non-current assets will be recognized in financial position, in the financial statement of Funsure Limited. What do you think? Because I think I also talked about So you know that the A now, the A part of the question is calculate impairment, if any. And
Yes.
we've already agreed that there's no impairment. And we said that
Yes.
the basis as to why there's no impairment because the carrying amount of the asset is less than its recoverable amount. Now, the B part of the question is now to show how the non-current assets will be recognized in the financial statement of Function Limited as at 31st of March.
But since there's no impairment, I think there shouldn't be any further action.
Thank you very much. That's the correct answer. So since the asset did not suffer any impairment, the non-current assets will be maintained at the carrying amount of 345 million. That is the answer. In the statement of financial position, so I hope you get this illustration one.
Yes, sir.
Okay, so let's move to illustration 2. So illustration 2 says Onome PLC has 8 assets for which there are indications for possible impairment. The fair value less cost of disposal and value in use in each asset are given below. You can see, so fair value is this first one here. Can you see? The value
Yes,
in
sir.
use is this one here. So in order to this thing, just this one, the requirement is that we should determine recoverable amount. Onome PLC. So determination of recoverable amount. So what we are going to do is asset. Let me do it like this, such a way you understand. Fair value less cost of disposal, value in use, recoverable amount, so we have asset ABC. ABC. So yeah, look at it. These are the assets. Then the fair value cost of disposal. $28,000, 34,000, 34, 6,000, 54,000, 87,000, not determined. Okay, not determined, you can make it 0. 27,500 and 85,000. Okay. Value in use is 44,500, 34,000, 52,500, 0, 79,500, 40,500, 33,500, 92,500. Okay. So do you get what I did here?
Can I see the question? Can we go back to the question? I'm
Okay.
struggling to read it. Okay. Okay. Fair value and value in use. So that is what we've copied. So we have to determine the recoverable amount of each of these assets. Okay, sir.
Okay. So now, do you recall what I explained recoverable amount to? What is recoverable amount?
Recoverable amount is the amount that that we will recover, or we will cover from an asset, from the sale of an asset. Like, I mean, the amount that we realize from the sale of an asset.
Okay, I agree with you. So recoverable amount is like the amount that an entity or a company will recover or realize from an asset, either from the sale or from using it continuously in the future. So it's either from sale or continuous usage. So the definition does not just stop at sale or continue usage. You get?
Yes.
So now how do you then determine, because if you even look at that definition indirectly is explaining fair value less cost of disposal and value. It's just explaining it. Because what did I say? I said initially is the amount that I cover or realize either from immediate use. Immediate use is fair value less cost of disposal. That's immediate use. Or continuous usage. Continuous usage is value use. Is what you use. Now, how do you then determine the recoverable amount? So, in your view, what is the recoverable amount of asset A?
Don't
worry, it's not hard.
It's going to be
putting you on the spot. You're the only person on the call. If not,
it's okay. So it's going to be the difference between the fair value less cost of disposal and the value in use, whichever is higher.
Oh, hey, exactly. So whichever is higher, because I said recoverable amount is the higher of fair value plus cost of disposal. Or value use. So the higher of the two of them 500. Yeah.
Mm.
So this 34, same thing. So you can just take anyone. You get asset A. Let me don't rush it. 34. Do you understand why it's 34,000?
Yes, it's the same. It's the same for both.
So asset C, what is the answer?
C is 56,000. The fair
Yes.
value being higher. 54,000. 87,000. Then 40,500. 33,500 and 92,500.
Yeah. So that's that for this illustration too. For illustration 3, it says Wi-Fi PLC has 8 assets for which there are indications of possible now. That's step 1. The step 1, like I told you that time, is there will be indication of possible impairment.
Mm-hmm.
There will be indication of possible impairment.
Some impairment.
That's step 1. Then step 2 is to now look at the recoverable amount. So in this case now, they said this guy already he has already seen indication, which can either be external or internal. The carrying amount, fair value less cost to dispose, and value use of each asset below they've given us. Required to determine the amount of any impairment arising in relation to each of the assets above.
Mm-hmm.
So illustration 3. Five pills. Carrying amount. Okay. So
Yes.
the carrying amount is 88,000.
Can we copy it from the source?
Okay. Let me.
Yes.
Okay.
Fair value less cost of disposal. Mm-hmm.
Okay. So not determined is 0. Not determined is 0. Now the question says we should determine the amount of impairment. So in order for us to identify whether an asset has impaired, step 1 is indicator. Question already told us there was an indication. Then step 2 is to determine the recoverable amount. That's step 2.
Yes.
So this is how you are going to address exam questions. So step 2 is the recoverable amount. Now our recoverable amount is what? So you
64,500.
because it's the higher. Okay. The next one.
65,000.
Okay.
84,500. 44,000, 68,000, 50, 60, and 90.
Yeah. So that's step 2. Then step 3 is our impairment.
Yes.
Payment loss, if any. And we already know that IAS 16 already tells us that impairment is when your carrying amount is more than
recoverable amounts.
So we're just going to look at the difference. Carrying amount is 88. Recoverable amount is 64,500.
54.
Do you get?
Yeah.
So let's just bring it down. Now, these ones that has negative, what does it mean? It means that the recoverable amount is higher than the carrying amount. It means that they did not impair.
No impairment.
Yes. So this one to 0. This will be our answer. You get it?
Yes, sir.
Yeah. So question 4. Mendes PLC estimates that an asset is expected to generate the following cash flow over its useful life. Over its useful life of 5 years. Inflow, outflow, year 1, year 2, year 3, year 4, year 5. They give us each of. All cash flow will occur at the end of the year. At the end of the 5-year period, the asset is expected to be sold for 48,500. The effective discount rate for Mendes PLC is 15%. Required, calculate the value in use. So this particular question is trying to test understanding of value in use. That is what this question is trying to test. Do you get? The question is trying to test understanding of value in use. But I said that value in use has 3 components. That's the amount you are expected to generate from that asset in future. That's number 1 component, which is the inflow. The amount you are expected to incur on that asset in future, that's outflow. Then, if you decide to sell it in future, how much will you also be expecting? That's the 3rd component. However, since you are determining all those values now, you need to actually discount them, because whatever amount you are calling those values in future, it won't be the same value today. That's why you need to discount it. Are you with me?
Yes, sir.
So illustration 4. Mendes PLC. Determination of value. Determination of value. Year, cash inflows, cash outflows, net cash flows, at 10% present value. Okay, so how many years are we looking at? 5 years. Year 1, year 2, year 3, year 4, year 5. So inflow. Outflow. So do you get what I'm doing so far?
Yes, sir.
So the inflow, the outflow. Now the net cash flow. The net cash flow is the difference between cash inflow and outflow. What's the difference? Discount factor. So do you know what this discount rate? Do you know what it means?
Yes,
This is
sir.
not your first time of
Yes,
seeing
sir.
it, right? Okay.
Yeah.
So it means
15%
it's a formula.
Mm-hmm. So we are going to use the formula, not 15% of the
No,
net cash flow.
no. It's this formula.
Oh, okay.
So before I calculate it, like let me, because it's very important. The way this SBR works, it's important you understand rather than cramming. But when you understand, you don't even need to cram. It's the understanding you. Now, what this means is that what we're trying to do is that the company has, from this question, they said the company has an asset that is expected to generate, the asset is expected to generate cash flow over the next 5 years. And they told us the cash flow, which is 90. Okay, there's even another one. At the end of 5 years, the asset is expected to be sold for 48.5. So it will be 90 plus 48.5. This is where I got it from. This part. Yeah. So the asset is expected to be sold. It's expected to be sold at for 48,500. Yes. So what we're trying to do is we're trying to get the amount in future, which is this is the amount in future that they will make. This is the amount it will cost them when using that asset. Then the difference between the inflow and the outflow will get the net cash flow. However, you are calculating the amount now. So you need to now understand that this $27 million they will make in year one. What will be the value of the $27 million in year zero? That is now. That is the reason why we have this column G, this discount factor.
Okay.
Because the 100 pounds you are holding today is not the same 100 pounds. Like the value will not be the same in a year time, in 2 years time. So because of that, you need to do the present value of that cash flow. Now, in doing that, so do you have maybe your calculator?
Yes, sir.
Okay. So in your calculator, it is 1 plus R, which will be, this is how you are going to do it in your calculator.
Minus
1
plus
R. R is the rate.
Rate 0.5.
Yes, 0.15, 15%.
Mm.
So raised to power.
Raised to power 1.
Raised to power minus 1.
Okay, minus 1.
Yeah.
Okay,
So
the n is raised to power.
Yes.
Okay.
That n is up.
Okay.
It's up. So it is 1 plus 0.15 raised to power minus
1.
N is number of days. N is number of days. So look at it. The first year is year 1. So that's why I'm putting minus 1.
Minus 1, yeah. So that should give us 0.86.
Yes.
870.
So
let's
what decimal please? 0.68,
0.869596.
Okay, yeah. So the same thing, let's do it for year 2. So what will just change for year 2 be minus 2. What will change for year 3 will be minus 3. Year 4 will be minus 4. Do you get?
Yes.
Because in the exam, they would expect that you do this, you calculate your value in use. The previous examples we have done before this one, they gave us the value in use directly. Sometimes you might need to calculate it yourself. Sometimes you might need to calculate it. And please bear in mind that your cash flow that you are using for determining your value use, please bear in mind it must be pre-tax cash flow. If they give you post-tax, you need to work back to
Come
make
again, sir.
pre-tax. I will show you. Please bear in mind, it must be pre-tax, must be before tax. That means not subjected. So do you understand how I got this discount
So
factor?
for the pre-tax, is it going to be the cash inflow?
Yeah, so if they give you pre-tax, most times they won't give you cash inflow and outflow. Just say that sometimes they'll just give you this F.
Okay.
They just give you this A, they will not call it post-tax. So, but what they will not give, but they will also give you like a tax rate. They will say tax rate is 40%. So what you're not expected to do is to now walk back to get your pre-tax. We'll do that. But let's
Yes,
just
sir.
first finish. So, but do you get this discount factor?
Yes, sir.
The present value would then be this net cash flow times this amount, this discount factor. So therefore, my value in use this is my value in use. Value in do you get?
Yes, sir.
Please, do you have any question before we proceed?
I'm with you, sir. No question.
Okay,
Just
give me 1 minute.
all right, sir. Okay.
Okay, please confirm you can see my screen.
I can't see your screen yet, sir. Okay, yeah. It's back.
Okay. So yes, so that's all for question 4. So like I said, before I forget, the pre-tax cash flow. Let's assume this was post-tax cash flow. If this was post-tax cash flow and you do this discount factor, present value, and you now tell the examiner that this is value, you have failed it. Because the standard specifically says that it should be the pre-tax cash flow that you should use in determining your present value. So in determining it, it means in exam, you would need to work back. So the examiner will only do you one favor. They will give you the tax rate. Let's say the tax rate is 40%. Are you with me? What you
Yes,
then
sir.
do is you will just say the pre-tax value. Formula is the pre-tax value divided by
multiplied by 40.
1 minus T. Yes.
Oh, we do 1 minus T.
Yes. So it is the post-tax value, post-tax cash flow divided by 1 minus tax rate. That's it. So if you do across board, now if you want to even confirm that what you have done is correct, you just do this amount now that you say is now the pre-tax. You know, the meaning of pre-tax means that before removing tax.
Tax, yeah.
Post-tax means that after removing tax. You agree with me?
Yes.
That's the meaning. That's just the basic meaning.
So, sir,
Yes.
From our own assumption now, the 27,000 that we multiply by 1 minus t is pre-tax.
Yes.
So
in this our example now, since the
yeah,
examiner did not see anything, if the examiner is silent, you will assume that it's pre-tax. But if
it's
the examiner
post-tax.
calls it out that it's post-tax, then it's you that will now have to walk back pre-tax. Do you get?
It's still, I'm sorry, it's still confusing because I believe that if it's before tax, that means we need to calculate the tax factor.
Yes.
So that we can get the post-tax cash flow value.
Yes. Yes.
Then we do the discounting factor and then we get the present value.
Yes. But in this case,
yes.
Sorry to cut you short, but in this case, this normally this illustration 4, normally,
Yes,
this illustration 4, the examiner did not even see anything like pre-tax or post-tax.
Yeah.
So the fact that the examiner did not see anything like that, you would assume that these values, they are pre-tax.
Okay,
so if they are pre-tax, you're not going to do anything. You're just going to calculate your discount factor, multiply it by your pre-tax, get your present value.
Okay.
But if they are post-tax, the examiner will say it. So I'm assuming here now, again, I'm assuming that this was not even pre-tax. All these 27,000, 48,000, 5291. I'm assuming that it's post.
I'm still confused.
Okay.
If it's post-tax, that means they've already adjusted for tax.
Yes.
So why do we need to adjust for tax again?
So what we're now doing is, if it is post-tax, let's basically agree. If it is post-tax, it means that it has been adjusted for tax.
Yes.
Yes. But that is not, the standard says, I don't want that. I want the pre-tax. The standard says you should use pre-tax cash flow.
Okay.
That's what the standard prescribes.
Okay. Okay. I get it now.
So that yes. So if the examiner did not say anything, please don't assume. But if the examiner say, oh, this cash flow you are using is post-tax, that is, I have already removed tax from it. So that's what I'm now assuming now, that, oh, all these ones here, they are post-tax. If they are post-tax, what I will just do in working back is, it is this amount divided by 1 minus t, tax rate. It means the tax rate, which is, I've assumed the tax rate is 40%. I've worked back. Now, even if I want to know that I'm correct in the exam, I will just say this amount times 40%. Can you see that it's 18? Abi?
Yes.
I will now say 45, which is the pre-tax, minus the tax itself. I will get this amount, see this 27.
Okay.
I do the same thing for 80,000 too. I will now say 80 minus 32, 48. Yes, I get 40,000. That's how you get it. So I'm just trying to paint a scenario so that you don't get confused in the exam. It can come, it might not come. Depends on what, it just depends on the mood of the examiner. But please bear in mind that what we are currently working on, the examiner did not say anything on this one. So you have already assumed that this is pre-tax. The examiner did not say anything. So because the examiner did not say anything, the examiner is silent here. They're going to assume that this cash flow is pre-tax cash flow. However, where it is not a pre-tax cash flow, the examiner will expressly state that it's a post-tax cash flow. So where it is a post-tax cash flow, what you will then do is to use that formula I have stated, which is the amount, the post-tax amount, maybe I should just put it down here, divided by 1 minus tax rate. That is what you are going to. That is what you are going to do. Yeah, this is the post-tax cash flow. That's it. Okay. Moving on. Question 5. So illustration 5 is saying Sterling Limited purchased non-current assets for. Okay, maybe you should read it so that it's an engaging class. And Madam Dami, can read it.
All right, sir.
Let me. Yeah, I'm pointing to.
Question
This one.
5.
Yes.
Sterling Limited purchased non-current assets for $900 million on 1st January 2021. The assets had an estimated useful life of 10 years with a residual value of nil. As 31st December 2025, the estimated selling price of this asset is only $590 million with associated selling expenses of $85 million. The anticipated net cash inflows from the assets are now $150 million per annum for the next 6 years. The market discount is 8% per annum required. Calculate the carrying amount of the assets as at 31st December 2025 and calculate the fair value less costs to sell of non-current assets. Calculate the value of the assets as at 31st December 2025. What is the recoverable value of the assets as at 31st December 2025? Calculate the impairment at 31st December 2025, if any, and take required accounting treatments.
Okay. If I move further, Mr. Bamdili, welcome.
Thank you, sir. Good afternoon.
Good afternoon. Are you with us?
Yes, I didn't know there was a class. I was thinking it's till 4:30.
Okay. Apologies. No problem. Okay. I don't know whether you have prior understanding of IAS 36, but we've gone far. But if there are parts that you don't understand, you can always
No.
draw my attention.
I'm okay. You can go ahead. I'm okay.
Okay. All right. Thank you, sir. So thank you, Madam Dami. Thank you, Madam Dami. So what the question says is that this company has non-current assets, and the non-current assets has estimated useful life. In the question, we have been provided with the estimated selling price, associated selling expenses, anticipated net cash inflow, the market discount, and the requirements is the first requirement is for us to determine the carrying amount of the assets as at 31st December 2025. Okay, that's fine.
Yes,
so let's at illustration 5. Sterling Limited. So the first requirement is to calculate the carrying amount. Calculation of carrying amount of the non-current asset as at 31 December 2025. Okay. Now, Madam Dami, if you recall, when we started this topic, I explained what carrying amount means. So please, can you just give me perspective on what it means? So we'll be on the same page. Just give me your own understanding. The way I explained it, how did you understand it?
Yeah, I've gone to search to look into my notes. So carrying amount is the book value less depreciation. and
So
any
it is your net
payment
book value.
losses. Yeah. The net book value,
So
less depreciation and any impairment losses.
So like I mentioned earlier, I said carrying amount is first off before the
Cost
introduction of
minus
IFRS.
NBV.
Before the introduction of you see, I can't hear you. Are you saying something?
No, sir, no, sir.
Okay. So before the introduction of IFRS, what we usually call carrying amount is our net book value. Take note, net book value. Under the statement of accounting standard that Nigeria adopted in the past, it was the net book value. However, it was with the introduction of IFRS that we started calling it carrying amount. So basically, what carrying amount means is it is the cost of an asset less the accumulated depreciation. Less if the asset is an intangible asset, then you will less it with amortization, not depreciation, because depreciation is applicable to non-current assets, while amortization is applicable to intangible assets. They do the same work basically, and their work is what it reflects the reduction in the value of the assets. And what will reduce the value of assets? Passage of time, obsolescence, technological factors, and so on and so forth. Those are the stuff that can actually affect the value of an asset. So your carrying amount is cost minus accumulated depreciation or amortization less impairments too. That is what we call this thing, carrying amount. So if you buy motor vehicle from a vendor for 5 million naira, and your company's accounting policy is to depreciate motor vehicle for 5 years, what it means is that the carrying amount of that motor vehicle, it means cost is 5 million, depreciation is 5 million divided by 5 years, which is 1 million. That's the depreciation. So 5 million minus 1 million, 4 million. That 4 million is your carrying amount. That's what we call carrying amount. Anything you see in textbook might want to confuse you, but it is just cost less depreciation, less impairment loss or amortization. So now in this scenario, let's apply that understanding to this scenario. Now in this scenario, the company bought the asset when they bought it in 2021. Yeah. So I want you to understand. I can easily get, because the examiner is saying that we should get 2025. So I will do two answers depending on which one you understand. So the company bought the asset in 2021. So you agree with me that what will be the cost of the asset in 2021? There will be the carrying amount of the asset in 2021. It will be cost. The cost is 900 million, right? 900. Then depreciation.
Depreciation will be cost multiplied by number of
So,
years.
so now depreciation. You know that depreciation is what? Gradual fall in the value of an asset. Once the value of an asset is reducing, means that the asset is depreciating. And there are different methods of depreciation. You have the straight line method, you have the reducing balance method, you have the sum of the years unit method, you have unit of production method. But most times, the two methods that is usually tested, most times, is usually the straight line method and your reducing balance method. So where the examiner is always silent, automatically you should just use straight line method. So what is straight line method? They just say the cost minus I say cost. The cost divided by the estimated useful life. That's what it is. So you're just doing your cost minus your estimated useful life. Now, in this case, what is our cost? Is 900, right?
Yeah.
900. What is the estimated useful life? 10 years.
4 years. 10 years.
This is 4. 10 years, yes.
But if there was residual value, we would include the residual value in it.
Sorry, sir, I can't hear you.
If there was residual value, we would deduct it from the cost before dividing by the
Yeah,
amount
so
of
in
years.
this case, there's no
And
residual
there's no-
value.
Yeah, okay.
If there was residual value, we would have said cost minus scrap value over estimated useful life.
Yeah.
Hello, sir. Do you understand what I just said?
Yeah, I understand you. I understand. It's fine. Can you go ahead, sir?
Okay. Okay, so cost minus depreciation. So our depreciation is 90,000. So cost minus depreciation. Now the carrying amount as at 31 December 2021. You agree with me that the carrying amount is 810,000. Do you understand this one?
Yes.
You agree?
Yeah.
But don't forget, the question is saying that we should do 31st December 2025. So this 2021, let's just bring this down. 2022. The cost is 900,000. Now, straight line method is if your depreciation value in a year is 90,000, it means that throughout all things being equal, throughout the estimated useful life, the depreciation will be that amount: 90, year 1, 90, year 2, 90, year 3, 90, year 4, 90. That's what straight line method. So if the cost is 900,000, the accumulated depreciation, that is what is coming from previous year, that's 2021, is 90. Then depreciation for the year is also 90. Do you agree?
Yes. Yes.
So carrying amount as at 2022. So carrying amount as at December 2022 will be 720,000. Do you understand what I did here? Yeah?
Not really, sir.
Okay. Do you understand year 1?
Year 1 is 90,000.
Yes.
So,
do you understand it?
Yes. Why are we doing it for 2022 as well?
Don't forget that the question says as at 31st December 2025. There's a shortcut.
Right.
It's because there's a shortcut.
Exactly. That's what I want to.
But I want to, it's because, I can't assume that you know the shortcut. That's why I'm doing this test.
Okay.
So I don't want to assume that you know the shortcut, but I want to first you to understand. I want you to understand this basic. This is the basic one. There's a shortcut that in exam, within 2 minutes, you have moved on to another question. This one might waste time, but it's just for you to understand the basis. Now, in year 1 of that asset, the company acquired that asset 900,000. The depreciation method is straight line method. So the straight line method, the formula for straight line method is cost minus scrap value over estimated useful life.
Yeah.
The cost is 900,000. In the question is another name for scrap value is residual value. He said it's nil, 0. So that's why in getting our depreciation, it is just the cost divided by the number of years. That's what we do That's how we got this 90. The cost minus depreciation is 810,000. Meaning that as at the end of 31st December 2021, what will be reported in the statement of financial position of the company as the amount of the non-current asset will be 810,000 naira, $10,000, $810 million. But the question is telling us that I want the value of the non-current asset as at 31st December 2025. So what it then means is that we need to walk down to 2025. So we have already gotten the one for 2021. Then for 2022, we will do the costs. That's 900,000 minus. Don't forget that it has suffered. If you don't like this method, you can also do carrying amount as at 31 December 2021. What's the carrying amount of previous year? In accounting, the closing balance of previous year becomes the opening balance of the next year.
Yes.
So look at it now. This is the opening balance of 2022. This carrying amount that we used to close 2021 will be the
opening balance.
Yes. Then to get the depreciation, that depreciation value is already constant.
Yeah, for the whole year.
90,000.
90,000.
So you still get 720. You see that it's still the same thing what we get. It just depends on which one you understand better.
Yes, sir. Can you not show us the shortcuts? This one is too long.
Okay, let's finish this one first.
But which one did they accept in the exam? Which one should we use in the exam?
Anyone is actually acceptable, at least for this level, because this SBR is more advanced than FR. So the shortcut is even preferable. Because you'll be doing group account, so you not really have time to be doing long stuff. The examiner expects you to just go straight to the point. Do you get? So
that's fine. Okay.
So for 2023, now using the same, let me use this second method. Now, the closing balance of 2022 becomes the opening balance of 2023. You agree? So that is carrying amount as at 31st December 20, which is 720,000. My depreciation is still 90,000 because it's straight line method I'm using. So as at the end of the year, to be this guy. Then 2024 too. Carrying amount as at 31st December 2023. So you know that the closing balance of 2023 becomes the opening balance of 2024, which is this is 30,000 here. Depreciation. This is straight line method. It's still 90,000. The carrying amount as at the end of that 2024 will then be 540. Then 2025. So the closing balance of 2025, 2024 rather, will become the opening balance of 2025, which is this 540,000, then my normal 90,000, then this guy 450. Yeah. So this is the answer for what we're looking for. This 450. Do you understand this method?
Yeah, it's fine.
Okay. Madam Dami, do you understand the method? If you're speaking of you too. Hello, Madam Dami.
Yes, sir.
So I'm saying that you understand this method.
Yes, sir.
Okay. So now, like you guys said, this method is too long. What we then do is, alternatively, to get shit. So we are supposed to get the history, the carried about as at 31st December. Now, knowing the definition of carrying amount is what? Cost less depreciation, less payment loss. That's the meaning. What is our cost? Our cost is 900,000, right?
Yeah, 2021.
For 900 million. I've graduated it, 900 million. Then accumulated depreciation. Now, this cost is the amount of that asset in year one. Let me come down to explain this. This cost is the amount of the asset in year one. So it is work for you to now say 900,000 minus 90. That's the value as at 31st December 2025. No, that's not what you're going to do. What you're going to do is you need to also get the depreciation, the total depreciation from the time they bought the asset up to 2025. That is what you're going to do. Now, based on this old method, we already know how to calculate our depreciation. You will notice that our depreciation for every year is 90,000. Yes, that's true. Now, to get the accumulated depreciation, it is what is our yearly depreciation? Our yearly depreciation is 90 million. 90 times how many years from the day they acquired the assets? Yeah, exactly. They acquired the assets in 2021. So, and this is the examiner is telling us that we should get it as at December 2025. That's 2021, 1, 2022, 2, 2023, 3, 2024, 4, 2025, 5. So 5 years. So that's 5 years. That's 5 years. Let me just put it here. 90,000 times 5. Yeah. So this is our carrying amount. So that you don't need to be doing year by year. Carrying amount. And it will be the same thing with somebody that does it the long way, 2025. Yeah. So you see that it's the same thing what we have here. 450 here. 450 here. Depends on which one you understand better. So do you understand this?
Yeah, for me, yes.
Okay. Madam David.
Sir?
So I said, do you understand this?
Yes, sir. Yes, this one is.
I can move on.
This one is. Yes, sir.
Okay, the next one, the question is calculate the fair value less cost to sell of non-current asset. Now, what is the fair value less cost to sell? Let's break it down. Fair value less cost. So let's have a fair value. I've said that when we go back to terms that we have, fair value is the price that will be received to sell an asset or paid, transfer a liability, an orderly transaction between market participants at the measurement. For this level, nobody will be asking you define. You won't really see many questions on define. At this level, you are expected to have technical knowledge and technical understanding of all the things standards are talking about. So all these definitions I'm currently projecting, it's expected that you should understand it. So you see all these definition is the price that will be received to sell. Yes, the definition is correct. This is what IFRS 13 said, but do you understand it? Now, in order to understand it, fair value is just saying that. Let me explain. If I have motor vehicle in my book, for instance, the motor vehicle is in my account, I called it 4 million naira. However, that same motor vehicle, if I decide to go to the market and sell that motor vehicle is 5 million. That 5 million naira, that is the value of that motor vehicle, is what we call fair value. Please take note. 5 million is fair value. That 4 million that is in your book is what we call carrying amount. They are different. 5 million is what, you want to sell it to the market, 5 million. That's fair value. That 5 million is fair value. You want to sell it. The point that buyers will be able to be willing to pay you. That 5 million is the market value. So, and in the process of selling it, what are they calling it? The motor vehicle, you will incur some expenses. So those expenses can be, number one, you want to advertise that motor vehicle. You want to inform potential buyers that, this motor vehicle is so amount. The amount, that advertisement cost is part of what forms your cost to sell. Advertisement cost. Because for you to sell it, you have to incur some cost. Advertisement is one of it. Another cost is sales commission. The person that wants to sell it for you, the sales agent, that wants to collect a commission. That one too also forms part of your cost to sell. So all these things, you don't need to cram it. You need to understand. You need to like paint a real life scenario for you to understand this. So with relation to this particular question now, they say you should calculate the fair value less cost to sell. You would notice something in this question. The examiner did not call it fair value. You will notice. Do you see this question? They did not call it fair value. Are you with me?
Yes.
Yeah, you will notice that the examiner did not call it fair value. Please bear in mind that once the examiner did not call it fair value, alternatively, the examiner can call it estimated selling price. That's what they will call fair value. Estimated selling price. If they don't call it fair value, they use it interchangeably. They can even call it market value. So estimated selling price is what they will call fair value. While your cost to sell is what we call it associated selling expenses. That's what we call it. So the examiner wants us to calculate the fair value less cost to sell. So to determine your fair value less cost to sell, I should just call it. So the B, calculation of fair value less cost to sell of the non-current asset. So fair value less cost to sell. Now in this question, we did not call it fair value. We say at 31st December 2025, the estimated selling price. And I said another name for fair value is estimated selling price. So otherwise known as estimated, for the purpose of the exam, estimated selling price, which is how much? 590 million.
590 million.
Yeah. So cost to sell is otherwise known as
associated selling expenses.
Selling expenses, which is 85 million. So just the difference, 590 minus 85. This is our fair value less cost.
Value.
Yes. So that's all. Then C, the C part of the question says calculate the value in use of the asset as at 31st December 2025. So let's calculate the value in use. Calculation of value in use of the non-current asset. Now, how do we determine value in use? I said just for Mr. Bambili like just joined, this value in use now, for the purpose of IAS 36, and a company, before a company knows that, can determine that an asset has impaired, the first thing they do is they look at indicators. We have two types of indicators. We have the external indicator and internal indicator. That is what they can control and what they cannot control. After they look at that, the second thing is that they will compare the carrying amount. They will derive their recoverable amount rather. In deriving their recoverable amount, it is usually the higher of fair value less cost to sell and value in use. Fair value less cost to sell, I just explained. I said that fair value is just the market value of an asset, while cost to sell is the estimated cost we incur in selling that asset. Then value in use, on the other hand, what that one means is that if I decide to use this asset that we are saying is as impaired, how much would I make from that asset in future? So the amount I'm going to make on that asset in the future, what is the value of that asset now? Because the 100 naira you have today, not the same 100 naira you have tomorrow, time value of money. So value in use is just, you are trying to bring the value of the amount you are expected to make in future. You're trying to know the value now. The amount you're trying to make from that asset in future, you're trying to know the value now. That's value in use. Now, how would you be able to ascertain value in use in the exam? There are different scenarios. Number one scenario, the examiner can give you directly. The examiner will just tell you value in use is $100 million. That means he has made your life easy. Scenario two, the examiner can do a breakdown. We tell you inflow, outflow, discount factor. So what the examiner expects you to do in that scenario is to first find the difference between the inflow that they're expected to make from that asset in future and the outflow, that is the cost they will incur on that asset in future. Because the same way you're looking at money you will make from that asset, the same way you also need to look at the money you are going to spend on that asset in future. Because, of course, for an asset to make money, you actually need to also spend money on that asset by maybe frequent repairs and maintenance. Exactly. So that inflow and outflow, the discount factor, examiner will give you that. The essence of the discount factor is for you to know the present value of the cash flow. So you would, once you now determine your present value of the cash flow, that present value of that cash flow is your value. That's the second scenario. So the scenario the examiner will give is either they give you the value you use directly or you are expected to calculate it yourself. So in this particular question now, you're expected to calculate the value you use. You're expected to calculate it yourself. But and we have the once the examiner says calculate the value you use yourself, you need to look for different components. Number one component is your net cash flow. Net cash flow. That's number one. Number two is the number of years they're telling you. Then the number three is the discount rate. Once they give you that, once they give you those three, you are good to go. Now, I also mentioned that the examiner can set trap. Another trap they can also set in value use that the net cash flow, the examiner can be silent for the net cash flow. If the examiner is silent, it makes your life easy. You are good to go. Calculate your net your value use. But if the examiner is not silent, for instance, the examiner is saying that the net it is post cash flow, post tax cash flow. what you are expected to do is that you are expected to work back to do pre-tax cash flow, because what IAS 36 recommends, IAS 36 specifically recommends that in calculating your value, you should or you must use only pre-tax cash flow. In the event that you are giving post-tax cash flow, you must work back to get your pre-tax. And in working back, the examiner will be so lenient to give you tax rate. The examiner just expects you to figure out how you get your pre-tax cash flow. And I said in getting your pre-tax cash flow to be your post-tax cash flow divided by 1 minus the tax rate. That is the formula. Now, for the purpose of this question, the 3 elements I say you should watch out for, get your values, we need to look for them. The year. In this question, he gave us the anticipated cash inflow from the assets, and now $215 million per annum for the next 6 years. 6 years. Meaning that what they are trying to tell you in the layman word is that this non-current asset that the company has, in the next 6 years, the company will make $150 million from it. That is the layman tradition of this. However, if you are saying that the company will make $150 million in the next 6 years, what is the value of that $150 million today? That is why we need this market discount. That is the middle of this market discount. We need it to get the present value of that 150 million. This 150 million is the future amount, but we need to get the present value. So to do that, what we then do is we have 2 methods. We have the shortcut and we have the long one. So let's start with the long one. Year 1, year 2, year 3, year 4, year 5, year 6. Then get cash flow, cash inflow. Yes. $115. Discount factor. So typically, this is how this thing is 1 plus r raised to power minus n. Minus n raised to power. Yes, because it's Excel, but it's raised to power minus n. Should be a way to make sense. Okay, yes. So minus n. This is so raised to power minus n. Then the discount factor is 1. This 1 plus r, let me explain. It is 1 plus r means rate. What is the rate? In the question, 8%, which is 0.08. Raised to power minus n. Raised to power minus n. N means number of years. So this first one is year 1 minus 1. For this, the second one to be minus 2. The third one will be minus 3. You will notice that the n is changing based on this year. Minus 4. Minus 5. Minus 6. This is how we get the discount factor. Then the present value is this guy times. Now, if you ask me that, today, okay, can you interpret this that I have done? What it means is this in year 1, the company is saying that if they use that asset in year 1, they will make $115 million in year 1. However, if I want to get the current value of that 150 million, that value will be $106 million as the current value. The same 150 million again that they will make in year 2. If I want to get the value now, it is $98 million. If they make $150 million in year 3, the current value of that is 91 million, and so on and so forth. So the total is what makes up our value, which is 531. Alternatively, before I go to the alternative, do you understand this, Madam Damian?
Yes, I do.
Madam Damian, are you still with us? We are not tired.
I'm with you, so.
Okay, was finish this standard today. Okay, so alternatively, there's a formula you can use. The formula is, you have a calculator. You can try it. Annual net cash flow times 1 minus 1 plus R raised power minus N divided by R. Yeah, this is the formula. Yeah. So the formula is annual net cash flow. What's our annual net cash flow? Is every year 150 million. So it's 150 million. So, but I will need your help. You need to use calculator. So, what you first do?
1 minus 1.08.
What you first do, so that I can guide you what you first do.
Rate is
On
8%.
On your calculator.
Minus raised to power.
So what you get is
6 years.
Times. Now, what you first do is do the 1 plus R raised to power minus N first. So that is, you do 1 plus 0.08. Are you with me? 1 plus 1.08. Yeah, that would be 1.08, right? Raised to power minus 6. Because do you know why I got my 6? 6 is the number of years, total number of years. 6. Are you with me?
Yes, sir.
Then divide it by 0.08. What do you get first when you divide it by 0.08?
Is this 47 million? I'm coming on. Let me put my commas. 47.
No, don't multiply it by 150 million. No, don't yet multiply
yes.
it. What you first get?
47. 683.
Sorry, can you give me like 1 minute? Let me go and get my calculator. Can't be 47. Let me just quickly get my calculator.
4.6.
Minus 1. By 0.08. Oh, minus 4.62. Oh.
Be 1 minus, not minus 1. No.
1 minus, yes.
So that minus 4.6 should be actually 4.6. There's no minus.
Oh, I mean, I'm getting 4 minus. So.
No, because you tweeted the formula.
Yeah.
There will be no minus.
Okay. 1.08 minus 6. Okay. So we are doing the one in brackets first. 1.1 minus
1.08.
1.08 raised power minus 6.
Minus 6, yes. And 1 minus No, then
Okay,
1
1
minus the
minus the
answer.
value I get.
Answer.
Okay.
Yes, I am.
Okay, okay.
Okay. Yeah, me too. So what did you get? So let's do it again. Let's do it together. Hello, can you hear me?
Yes,
Yes, I
sir.
can.
Okay, let's do it together. 1 plus 1. So the formula is for the shortcut annual net cash flow times open bracket 1 minus 1 plus R close bracket minus N over R. Now, what you do is the first thing is to do 1 plus R. So that's 1 plus 0.08. That's 1.08. Raised to power minus N. N is number of years. That's 6. N is 6. So currently, I'm not on my calculator. Currently, it's not the final 0.6301. Is that what you have? Hello? Can you hear me?
Yes, we can hear you.
So is this what you have on your calculator? 0.6301696.
Yes, it's correct. Yes, it's correct.
Okay. Madam Dami, is that what you also have?
Yes, sir.
Okay, so we will now do 1 minus that answer. 1 minus the answer. That's 0.6. What you now get is 0.369 830 373. If the is long shot, that what you
Yes. Yes.
okay. Then let me you I'm not talking. No. I just want to carry you guys along so that we're not too fast. Hello, can you hear me, Madam Dami?
Very well, sir.
Okay, then you now do divided by the rate. So divided by R, which is 0.08. What you get 4.38799. Is that what you get?
Yes, sir. Yes.
Okay. So that means, please look at your screen now. See, that means you have gotten this one like this. This one I'm highlighting. You have gotten it. Then multiply it by 415 million. Or 115 million. So you see that you get the same answer. Or to be approximation, just small approximation. So are you with me? Yeah. Please, I'm not
Yes.
I'm not hearing you people. I'm worried.
No, we're with you.
Okay. Madam Dami.
I'm with you, sir.
So did you get this value?
Yes, sir. Exactly.
Okay. So which one do you prefer? The first method or the second method?
The second method, though. It's just that
Mr.
somebody has
Bamidele,
to
which one?
be, he has to be very sure of the formula.
Okay.
But there are conditions for the second method.
Yes. So the condition for this second method, thank you for saying that, is if the cash flow is constant. Madam, Dami, please take notes. If the cash flow is constant, that's when you would be able to use the second method. But if the cash flow is not constant, you cannot use that second method. This is what you have to use. This is the reason why I'm teaching you guys. So what do I mean by if the cash flow is constant? It means that cash flow is constant means what we have now. But if the cash flow is not constant, means in year one, let's say it's 100 in year one, in year two, it's 80, in year three, it's 60, in year four, it's 70. You can't use this second method here.
Okay.
Sure, we are clear?
Yes, sir.
Yes. So please, let's take that one in mind. Let's bear that one in mind. Okay. Should we move on?
Yes, sir.
Yes, let's.
Okay. So the next bit is, what is the recoverable value of the assets as at 31 December 2025? So that's our next D. So, Madam Dami, what is recoverable value of the assets? Can you teach us?
Recoverable value as at December.
Yes, ma'am. Should I go up? That
is higher of the value in use and
yes.
cost of disposal.
So yes. So Mr. Bambili, in your absence, I already explained recoverable value. Recoverable value is just the higher of fair value less cost to save and value in use. Fair value less cost to save, value in use. Fair value less cost to save, we already determined it before. This is it here. Value in use, this is it here. So our recoverable value will be higher of it. This is our recoverable value. Please call my attention if you don't understand anything. So that's all for that part of it. Then the next bit is calculate the impairment at 31 December 2020 and state the required accounting treatment. Okay. So, Madam Dami, what's the impairment? As the assets impaired, that's and that's it. Even as it impaired in the first place.
I think no.
Okay, Mr. Bamdele say no. Why do you say no? And okay, let me use that. Why do you say no?
I think the recoverable amount is higher than the net book value.
Okay. Okay, well, let's go and check our net book value. Our net book value oh, okay, it is higher than it. Let me change it. Let me assume I want impairment. Okay. So there's no impairment because the carrying amount is less than
the recoverable
amount.
value.
But let's assume that let's assume that the carrying amount was
Or as at
carrying
end
amount.
of 2024.
Yes. So there's no impairment loss. Basically, this question. There's no impairment loss on non-current assets, given that carrying amount is less than the recoverable amount. So it means that, and the question says, and the accounting entry. So whatever there's no accounting entry that will be passed again. Whatever is the value of the carrying amount will still be maintained in the books, which is this 450 million, will still be there. But now let's assume that our carrying amount was, let's use maybe 2024 value. If the carrying amount was at DB was 540, this is just, I just want you guys to understand something. 540, and the recoverable amount, which we already have, is 531. Surrounds me like a shield. It is covering me from now until the day I see my King. Madam, show you the mic.
Oh, sorry.
Oh, no problem. So the impairment loss, there will be impairment here. The reason why there's impairment here is because the carrying amount is more than the recoverable amount. That's why there's impairment here. And the accounting entry in this scenario would have been debit P or L. And I said P or L, it can either be cost of sales or administrative expenses. So it depends. It depends on the assets that we're talking of. If the asset that was impaired is related to your production, it will be cost of sales that it will go to in your P&L. But if the asset we are referring to is not related to your production, it's an indirect thing, it's going to go to your administrative expenses. That is it. So it will be non-current assets. So this guy will go here, debit it, and to reduce the value of the non. Yeah. So that's that for this question. Do you have any question before we move? Mr. Bambile and
None for me.
I have a question.
Okay.
Okay, I've seen it. I was the present cash flow for the whole year.
Yes.
Yeah, I initially was wondering where it was from, the 115,000, but I've gotten it now.
Oh, okay. So can we move on?
Yes, sir.
Right. Is it fine if I delete this one?
No problem.
Since it's not in the question. So illustration 6. Yeah, you can read the yeah, Mr. Bambile, help us read illustration 6.
Okay. Maradona PLC acquired a property 4 years ago and measured the property using the revaluation method of IAS 16. At 30th September 2024, the carrying amount of the property is 950 million, being revalued amount less accumulated depreciation charges. The revaluation surplus reserves of the company amounted to 60 million, of which 25 million was attributable to the revaluation of this property in prior year. At 30th September 2024, the estimated selling price of the property is 990 million, which with associated selling expenses of 120 million. The anticipated net cash flow from the property is 300 million per annum for next 3 years. The remaining useful life of the property okay. So the remaining useful life of the property at 30th September 2024 is 3 years. The market discount rate applicable to Omega PLC is 10%. Required, calculate the fair value less cost to sell of the property at 30th September 2024. Calculate the value in use at 30th September 2024. What is the recoverable amount of the property as at 30th September 2024? Calculate the impairment on the property as at 30th September 2024. What is the accounting entry? What is accounting entries and treatments?
Okay, thank you, Mr. Bamjile. Okay, so so this is like a classwork. So I expect you guys to do it. Let's see what your answers will be. I just 5 minutes and get and do it. Let's start with the fair value less cost to sell. So then we'll now discuss it once you are done. Just let me know what you are done. I hope you guys can hear me.
Yes, sir.
Yes, I can.
Okay.
I'm done for the first one, the fair value. Well, should we do everything or we are doing this one by one?
You can do everything. Then we'll take
Okay.
taking it one by one. But do everything. Hey guys, done.
Not yet, sir. Small plus R plus 0.17 is to power minus 1. Okay. Final. It's Let's give him a sentence.
Hello? So I think we should just can start now. Hello, can you guys hear me?
Yes, we can.
Please.
Okay. Madam Dami, you're
Sir?
almost done now.
Yes, sir.
Okay.
On
Just
the
because of time.
question.
Because I
Okay,
plan on
sir.
finishing this standard. We have so many things to still cover later on.
So we still have class. I still have class by 4.
Okay. Okay, so let me just quickly round this one up. Okay, Maradona PLC So the first requirement is calculate the fair value less cost to sell of the property as at 30 September 2024. So let me share my. Can you see it?
I think the question.
Yes, sir. You can see the question.
Can you see the Excel too?
Yes.
Yes.
Okay. So our fair value, we already know that our fair value is otherwise known as estimated selling price, which is 990. Our cost to sell is 120. Can you confirm this is what you got?
Yes, sir.
Yes, is what I got.
Eh?
Yes, it's correct.
870. Yes.
Okay. Okay, thank you. So let's move on then. The next one is calculation of value in use as at 30 September 2024. So the question, I told you that when you are doing your value in use, there are three components you should look out for: the years, the net cash inflow, and the discount factor or the discount rate. So the years, they said from the property is $300 million for the next 3 years. So that means 3. What is our net cash inflow in this question?
300.
So every year they envisage to make 300. What is the discount rate? 10%.
10%.
Using the other method. So is this what you got?
Yes. 746 055 595 597. 2.4 2.487.
So 2.486. Okay, yeah. So Madam Dam, is this what you also got?
Yes, sir. It's just I think it is due probably due to approximation.
Yes.
So yeah, it's very close.
Okay. Recoverable value the property.
Yeah.
Property. So the fair value less cost to sell is 870, right?
Yes.
The value in use
Yes.
is 740. So our recoverable
146.
value is 870.
870.
Yeah. Yeah.
270 million. Okay. Calculate the impairment on the property. So impairment is carrying amount. What is our carrying amount in this question?
950.
It's 950. It's in the question.
Yeah, because in this particular question, we don't need to calculate carrying amount. They've given us directly.
They've given us
Yes.
already.
They said as 30 September 2024, the carrying amount is 950 million, being revalued amount less accumulated charges. That's 950. Less recoverable amount. Recoverable value. So our recoverable value is this guy.
870. Yes, 870.
So our impairment. So there's impairment here because the carrying amount exceeds the
Lower.
recoverable. The next one is the accounting treatment
Entries.
for entries. So accounting entries. Okay, Madam Dami, how did you post this?
So I did not. I'm not. I wasn't sure. I don't know how to do that part.
Okay, what was
I know
it?
you showed. I know you showed me earlier, but it's confusing.
Okay, Mr. Bamdele.
Okay, I think I debited the P&L.
Eh?
I debited the P&L.
Okay,
Yeah, the profit or loss statements. Admin. And I credited the
Yes.
assets.
yes. Okay, so this is it. If in this case now, let's go back to the question. They said Maradona PLC acquired the property 4 years ago and measures the property using the revaluation model of IAS 16.
Yeah.
At 30th September, the carrying amount, blah, blah, blah. Now, you agree with me that under IAS 16, there are two models. We have the cost
Yeah.
model
It's
and we
model
have the
and
revaluation
valuation
model.
model.
Yes, yeah.
Abi?
Yes.
Mhm.
If it was, let's assume that this question was, he said, I didn't mean this first part was, Maradona PLC acquired the property 4 years ago and measures the property using the cost method of IAS 16. What our accounting treatment would have been is debit P or L
Credits.
with cost of sales or
Street.
admin expenses,
Admin.
what the
Okay.
case may be.
I get it.
Then credit the asset account, property. In this case, asset is property, which is
Yeah.
80,000, right?
Yes.
That's it. This would have been the accounting entry for cost model. However, this question said that they use what? Revaluation model.
Evaluation.
And when they are talking about revaluation model, revaluation is they are trying to adjust the value of that asset to meet current economic reality. That is what revaluation is. And we can have what we call either revaluation surplus or revaluation deficit. For the purpose of this topic, let's focus on revaluation surplus. Revaluation surplus is where the valued amount is more than the carrying amount. That's valuation surplus. When is IAS 16 to purchase more, but that's what valuation surplus is. If you say the market value of an asset is 50, but what you are carrying into your book is 30, 50 minus 30 is 20. 20 is the valuation surplus. Now, because the question already says it's valuation model, if you use this accounting entry you use under this cost model, then you're not entirely correct.
Yeah.
You're not entirely correct. That is, so what the standard says is that when there is impairment loss, for a revalued asset, the value of that impairment loss must hit that revaluation surplus account up to the extent of the impairment loss.
Loss. Yes.
First. If there is impairment, let me come again. Once there is impairment loss for a revalued asset, the value of the impairment loss must hit the revaluation surplus account up to the extent of the impairment loss. That is, in this case now, what is the revaluation surplus? In this case, they said the revaluation surplus amounted to 60,
60,
but
okay.
25 million is related to that particular asset. So that means it's 25 million.
Okay.
25 million. So we have it at the back of our mind that, let me put it somewhere outside. Valuation surplus is 25. So starting with the credit side, credit will not change. It will still be property account that will still be affected. Which is what is the impairment loss? The value is still 80,000. So will not change. But the debits change. The first thing you will take it to evaluation surplus account. Up to the extent of that value, which is 80. So the impairment loss is 80. But what is in evaluation surplus is 25. So it's 25,000.
25, yes.
Because you cannot debit the whole evaluation surplus 80. That will be excess. It does not make any sense. Do you get?
Yes.
So the difference between the 80 and the 25 will now go to P&L.
Yes. 55. Yes.
That's 55. So this is our accounting entry. Do you have any question?
It's fine by me.
Okay. Madam Dami, do you have any question?
No questions, I get it.
Yeah. So please, let's also bear in mind that once you see that evaluation, asset that has been revalued, you need to be very mindful of the accounting treatment. You will first take it to evaluation surplus up to the extent of the available balance in that account, that evaluation surplus account. Then, if there is a difference, you take it to P&L. Let's assume that this impairment loss was 20,000. If the impairment loss was 20,000, what we would have done is we debit evaluation surplus.
Everything.
With 20. With 20. There is nothing that are taken to P&L. Just credit property.
Property.
It's 20. That's all. Nothing is going to P&L. This is because impairment loss is lesser than valuation surplus. Okay. So I want to try and paint one scenario to explain something on this impairment. Still on impairment. Now, let's assume the company has carrying amount of their asset. Let's assume is 400,000. Method of depreciation is straight line. Meaning useful life. Meaning useful life is 4 years. Residual value. Let's assume it's 50,000. Net cash flow of 80,000. Mm. So I'm trying to form this example to explain something to you guys. Estimated selling price is 250. Estimated selling cost is 15,000. Okay. Discount rate is, let's say, 12%. Okay. I have everything I need. Now, if you want to calculate the first one, now, if you want to calculate in this scenario now, you want to calculate this carrying amount as at 31 December 2024. So the first one is, let's calculate value in use. To calculate value in use, let me just bring, not to waste time. So to calculate value in use, our net cash flow, what's our net cash flow? 80,000, right? Net cash flow. The number of years is 4 years. Can you see?
Oh, yeah.
Yes.
Yes.
Yes,
Then
sir.
the discount factor,
Well,
1 plus R. In this case, the R is what? 12%.
12%.
huh?
So that's 0.12. Minus 2. Okay. Hey, look at this thing now. In this particular example, you will notice something. The residual value, they gave us the residual value 50,000, 80,000. Common mistakes that people make in exam is they don't consider residual value in the last year.
Okay.
So
Yeah, 4.
what the examiner will give you residual value, but because of the way you have practiced, if you notice, most of the previous questions we have done, there's no residual value. Residual value was nil. But in this particular case, residual value was given, which is also ascribed value, 50,000. Because it was given, and technically, what's the meaning of residual value? Amount you're expected to like generate, or amount that the value of that asset as at the end of the useful life. So, or you can also say the amount that you get if you decide to sell it at the end of the useful life. So that's the reason why we are adding it in year 4. If it was 5 years too, you add it in the year 5. So it is plus 50,000. That's 274. That's the value in use. So this is what changed between this one and what we have done before on value in use. That's the major change. Do you understand?
Yes, but can we separate the amount into year 4,
Okay.
80, year
Okay,
4,
okay,
50?
okay.
That one is
That also
allowed?
works, but it will still be 4-4.
Yes, 4-4. Yes, 4-4. 80, 50. And same rates too.
Yes. So this one. Yeah. Okay. Then the next one is less the recoverable amount. So to get our recoverable, our fair value less cost to save, right? What is our fair value? Estimated selling price, right?
Yes.
Our estimated selling price is
250.
250,000. Is 250,000. Our estimated selling expenses
15.
is 15,000. Hmm, 15,000. Yeah. Let me 250 minus. I think I need to type it manually. 250,000 minus 15,000. Fair value less cost to save. You get what I'm doing now?
Yes.
Yes.
Then value in use. Value in use is this guy. I will just
274.
so our recoverable amount is then what
274.
is
274.
274,764. Okay. Now we want to ascertain impairment or impairment loss. There's something I want to drive at so that you guys understand. I'm using an example to drive on my phone. So my carrying amount, the carrying amount, what's our carrying amount? This question has been given to us
Yes. 400.
is 400. So is there impairment?
No. Okay. Impairment there is.
Recoverable amount.
17.
So we know why there's impairment because the carrying amount is more than the recoverable amount. Now, the accounting treatment. What's the accounting treatment? What's the accounting treatment? You guys should teach me.
That be the P or L.
So you know this is impairment loss as that. This is as at 31. December 2024. Okay, the accounting treatment is debit what?
Debit P or L with
P or L, profit or loss.
yeah,
And we said it can either be cost of sales
cost or administrative.
or administrative expenses, depending on the assets. Yes. And credit
Assets.
assets. Credit asset account. So P or L, the value is what? This value. Yes. So now, what of if this is where I'm trying to, this is the main reason why I'm doing this particular example. Now, what of if the examiner now says calculation of depreciation charge as at 31 December. As at 31 December 2025. Now I have a question. Let's make it very interactive. Do you think, when you look at this scenario I painted now, this method of depreciation, I said the way straight line method work is, you will say your cost minus the scrap value. Cost minus scrap value over estimated. That is your listing. So it is, what's our cost? Our cost in this case is, okay, I didn't put cost, but you understand what I'm saying now. Straight line method is cost minus scrap value by estimated useful life. That is year 1 depreciation, year 2 depreciation, year 3, year 4, year 5. Depreciation amount will be the same. That is what it will be. So in this case now, if you want to use this case, it will be 400,000 divided by the remaining useful life, 100. For the next 4 years, it will be 100. You agree with me? How did I get this 100? It is the carrying amount divided by the remaining useful life. Are you with me? So
Yes, sir.
Now, so what will then happen now is that the company has straight line method depreciation 100, 100, 100. But do you think this amount will still be 100,000? Given that, no, sorry, this is not going to be 100 because we have scrap value. I'm only submitting scrap value. 50,000. Yeah. So when we look at this now, 7,500. Now, do you think that this depreciation value would it remain the same after impairment has occurred? Yes or no? If it's yes, why? If it's no, why? Do you understand?
I understand. And I'll say no.
Okay. Why?
Because the carrying amount will no longer be what it used to be. If you now change to what's we now need to factor in the impairment loss.
Okay. Madam Dami, what's your view?
I will agree with him as well.
Yeah. But do you understand how I got this 87,500?
Yes, I did. But I was also thinking, since they called it carrying amount, do we still go further to deduct? Do we still go further to deduct the residual value from it, or just for information's sake? That's just my only question on that aspect.
Okay. So in this case now, I'm just trying to paste a scenario where the residual value, because residual value has to be considered, because that would be like the amount of money you would generate when you want to sell that asset at the end of the useful life. And in calculating depreciation, typically you're supposed to do cost minus scrap value over estimated useful life.
Yes.
So there is no cost here. In place of cost, we have carrying amount. So using that same formula, is carrying amount
minus
car value
residual value
over estimated.
over number of years.
Okay, noted.
Okay.
Okay, so you agree with me that this this would not exist. Like it will not continue again. It will not be 7,500. The reason why it's not be like that, you have actually said it. The reason why it's not like this 7,500 will cease to be the depreciation charge after the because once an asset, the carrying amount of that asset has already been replaced with recoverable amount. And as a result, any associated annual depreciation charge will reduce. Let me come again. When an asset has impaired, it actually means that the carrying amount has now been revalued to the amount of recoverable amount. That's what it means. And it means that your carrying amount, the depreciation you have been doing before in the past is high because of high carrying amount. But when you now lower the carrying amount after you have already account for impairment, that depreciation that was high in the past will now be low now. Because at the end of the day, the reason why I did all this debit credit, if you notice, the reason I did the debit credit is to say that the actual amount of the asset is this 274,764. Do you agree with me?
Yes.
Because all these debits, when you say debit POA, credit assets, when you credit assets with 125, you are saying that 400,000 minus 125, the 274 is the new value of the asset, meaning it still is reflecting the recoverable amount. And it effectively means that the depreciation you're using before you get your carrying amount is too high, you have overstated. That means going forward, after you have already done your impairment, the depreciation will come down. Madam, do you understand?
Yeah, I'm trying to, but I have a stupid question.
No, it's not stupid. Nothing is stupid. You can go ahead.
What makes impairment different from depreciation?
Oh, okay. That's actually a very good question. Impairment is different from depreciation because for depreciation, one major difference is that depreciation is the gradual fall in the value of an asset as a result of wear and tear, obsolescence, passage of time, change in technology. That's the definition they even told us from secondary school. But when depreciation in an advanced level is you are spreading the cost of an asset over the estimated useful life. You are spreading the cost of an asset. That is why when you had up depreciation in year 1 up to year 4, let's say that's 4 years useful life. When you had everything up, you would get the cost of that asset. And what depreciation is trying to say in a layman perspective is that when I buy an asset today, 3rd of August 2025, if I buy it for 4 million naira, depreciation is saying that that 4 million naira, that asset will not, even whether you use it or you do not use it, if you take 1 month, 2 months, 3 months, that asset cannot be 4 million.
Yes.
Due to time, passage of time,
It
cannot be 4 million again. Not possible. That is depreciation for you. But impairment is saying that if some factors exist, then there are signs that an asset might have impaired. A good example is market value of an asset. Recall when I said that if the market value of an asset reduces significantly, there's a possibility that that asset has been impaired. And the way you will know that that asset has been impaired is if you look at, for example, property, building. Building in your book of accounts, you are saying building is 250 million. However, government passed a law that actually affected the prices of building. So building like yours is no more 250 million. Based on the law the government has passed, has reduced the value of the building, let's say 150. What it then effectively means is that the 250 million you are calling, you are stating in your book of accounts, you have overstated it.
Okay.
You are already misleading. What it means is that you are misleading the users of accounting information. Because your accounting information or your financial information or your financial statement, it must be faithfully represented. Whatever you are putting there must be free from error, must not be biased, must be true, must show a true and fair view. In order for you to know that the financial statement is showing the true and fair view, you must carry out that impairment. That building 250 million, the market value of 150 million, you must reflect that 150 million in your book. Why is it that like that? Another reason is because if you decide to sell that building on that same day, you will not get that 250 million naira. You will get 150, meaning 100 million is like a loss. So you must show it as that in your books. That is why we have impairment. So it's different. If there are no factors, if any of the factors are effective as stated, they do not act on an asset, then impairment loss would not occur.
Okay.
Except for goodwill and intangible assets with indefinite life. Those ones, you don't need to look for any indicator or factor. You must always assess for impairment for those ones at the end of the end of the company. Goodwill and intangible assets, you must always test for impairment for those. Aside from those two, every other asset, something must have occurred in the economy. For example, now, or then in practice, many auditors, when Tinubu came, that when you remove fuel subsidy, you devalue the currency, I am sure that auditors would have actually tested for impairment when they came for year-end for many of the companies. Would have tested the assets that, oh, the asset that this company has stated in the book. I hope they've not overstated it. They would have tested for impairment, compare the market price, compare how much they will realize, compare it with their carrying amount. Do you get? Hello, have I been able to address your question?
Yes, sir. Yes, sir.
So now, because of that now, because when you look at when the carrying amount of an asset is higher than the recoverable amount, what it means currently is that there's impairment, number one. Number two, it also means that the depreciation, you have been claiming high depreciation. Now, what is the impact of high depreciation on profit? High depreciation means that you are making lesser profit. That's the impact. High depreciation, because no depreciation is an expense. The higher the expense, lower the profit. The lower the expense, the higher the profit. I don't know why I'm making sense.
Yes, sir.
But in arriving at profit is revenue minus cost of sales, get gross profit. So gross profit, add other income, less administrative expenses. So the more expenses you have as a business, when you are incurring expenses, as if you have a business and you are incurring more expenses, it means that the profit you will report at the end of that year to be getting low. But if the expenses you have is low, it means the profit you would report at the end of the year will become high. Now, in relation to impairment loss, once an asset is more than the carrying amount of an asset is more than the recoverable amount, what has happened is that high depreciation has actually been charged to the P&L. So when the asset when you have now factored in impairment, it means that going forward, the depreciation will now become lower. Why? Because the value of the asset has also become lower. There's a relationship. If the value of an asset is going high, depreciation will also be going high. If the value of an asset is going low, depreciation will also be going low. Now, in this particular case, there's even a formula. The formula is your recoverable amount to get the new depreciation going forward minus the revised residual value, if any. divided by revised remaining useful life. Now, in this case, what is my recoverable amount? My recoverable amount is what? You guys should tell me. What's my recoverable amount?
274,764.
274,764 minus revised residual value.
Probably. No.
So in this question, they didn't revise it, but we have residual value. If the examiner did not give you revised residual value, the residual value you have in the question is what? If they don't give you revised, yes. If they don't give you,
so repeat that part.
Okay, I'm saying that this. If you look at this question up here, there's a residual value 50,000.
Yes.
In some questions, you have to have revised residual value. So the reason why they might revise it is because the asset amount has also been revised. You know, when you account for impairment, they have also changed the value of the asset. So the company can also revise, can also say, in future, I'm not sure we would make 50,000 if we sell this asset. We might make 40,000. That's what they can say. So if you have this in a question, this is what you're going to do. This is what you're going to do. But where this does not exist, it is what you have already in the question. This is what you're going to do. Then the revised remaining useful life. There's no revised remaining useful life. See the remaining useful life we have in this question, which is 4 years. 4 years. 4. So my depreciation will be this guy divided by this. This is my depreciation. Now you can see that my depreciation has reduced from 87,500 to 56,191. I don't know if I'm making sense.
Yes, you do.
So let me 274,764 minus 50.
I think the comma.
Okay.
Bracket.
Yeah.
Okay.
So this is it. So the whole essence of this particular example is I was trying to show you the fact that once an asset has been impaired, going forward, the depreciation of that asset will also reduce on the basis that the carrying amount has also reduced to the recoverable amount. That is what I'm trying to show you in this whole example. Can I move on?
Yes.
Okay. So the next one, we're almost done. We're almost done actually. So the next one is impairment loss.
AAA class has started.
Okay.
Okay. We have yes, AAA.
I just have CGU and impairment reversal. But I can. Should we continue next week?
Yes.
And that'll be fine.
Okay. Okay. All right, no problem. All right, thank you. Thank you very much.
So are we doing half 12 next week? Are we doing 12:30 next week?
So you see that at 12:30 now, you've eaten out of my time. I'm supposed to stop 4:30. If we can do 12:30,
12 o'clock is too early.
Well, the time that was allotted to me is 12 to 4.
It's 12 to 4.
Yes, and we didn't start this class on time. We started 12:30, around 12:30. I even thought I would even finish the standard.
Let's do 12:30 next week. We'll see. We'll see
All
how
right,
it goes.
it's fine with me. If it's also fine with Mr. Bambila, no, it's fine.
Yes, it's fine.
Thank
All
you.
right, no problem.
All right,
Thank you very much.
Yes, sir.
You're welcome, sir. Thank you, sir.
Yeah.
Bye, Dami.
Bye.